Hello, everyone, and a very warm welcome. Let me take the opportunity of wishing you and your families a very happy and prosperous 2025. As we start a brand new year, let's take a step back and reflect on the year gone by. We saw increasing a number of IPOs, QIPs, and money raised through these channels. On some of these matrices, we were far ahead of even the developed world. While these numbers surprised us, what was even more surprising was the number of new age companies coming to the capital markets and at such healthy valuations. While most of us have some kind of framework in analyzing traditional companies, new age tech companies come with their unique set of complexities. To understand this particular segment, I am joined in by Ms. Meeta Shetty. Meeta is a fund manager with Tata Mutual Fund and manages funds like the Tata Digital Fund and the Tata Innovation Fund. She's a CFE charter holder and has an experience of about 15 years in the capital markets. Meeta, a very warm welcome and wishing you a very happy 2025.
Thank you, Megha, and thank you, Harsh. Thank you for hosting us and wish you both a very happy new year as well.
So, Meeta, my first question to you is that we have come a long way from, just having startups to these companies getting listed. And if I have my numbers right, we have about 17 such entities which are listed. When we look at traditional matrices, be it profitability, disclosures, corporate governance, etc., these companies are diametrically opposite to the company. We have some kind of competence in analyzing. I wanted to understand from you that are you finding this space attractive and how do you look at the listing of such companies?
Sure, Megha. So I think it's been almost, 3, 4 years now that we've had listed companies in the new age areas, or more so I would call a platform company rather. So yes, absolutely, they are different in the fabric that they have been, stitched and they've grown versus a traditional company. We all have got used to look at traditional companies which have a plant and a capex and a employee base and the very regular format of any manufacturing or a infra company would have some assets across whatever verticals that they are in. So naturally these companies are different in their own way, and it does get us onto a job where we have to look at them very differently. We can't go with that traditional mindset and try to understand these businesses because the entire genesis is very different. So certainly it did add to a lot of our desk job to understand as to how to kind of figure out as to how these companies would be and how they will grow, and how to ascribe, more importantly, the value that we are willing to pay, and how do we believe that how the value will grow going forward. So certainly there was it was not very traditional, so obviously it had to had a different mindset, little out of the box thinking. But these were definitely interesting because now we may have we may not have invested in all the 17 or 18 companies that are listed, but we have definitely evaluated them. And it made sense because like any other traditional company IPO, we evaluate most of the companies that are trying to come to the market, given their size, and if it's not a too small liquidity concern company, then we will obviously want to evaluate. So it can be a fit for any funds because we have a bouquet of over 25, 30 odd schemes. So we evaluated these companies as well, the new age as well. And we really found that these companies had, obviously, one, the aspect that profitability was not there and there was no vision of when they will turn profitable. But at the same time, they were very, very fast growing companies. The growth rates were, very high, and it definitely warranted us to, look at them more closely and try to evaluate if they make a fit. So we did end up taking few companies in the funds, and we still hold a couple of names, I would say.
You did mention that there was no sense of profitability that we had, and while of course the projections were very high. And if we just take a step back and understand why it happened, it is largely because most of these companies were VC funded. And typically, most of the VCs come with a time horizon of about 7 to 10 years. And when they come in the initial years, they have very aggressive techniques to expand the business to, get the largest possible share of the total addressable market, get the right product market fit, etc. Typically, when, these companies get listed, and VCs do take a exit when at the permissible time, does it have anything left for the minority shareholders? Because the market does get saturated because they have tried to get the largest possible share of market already in their respective spaces.
Well, I think I would disagree. I would disagree on this point, surely. So one, the point you made that the value, the valuations parameter because of the profitability not existing was there and the estimates were very high. I would not, because we have our own estimates and we have our own working, so we don't rely on market estimates. So that was one thing to address. Second is, I disagree on the point that is there more left on the table, because I mean, if I have to just give you some share data points, when a food delivery company or the beauty platform companies were getting listed, the market penetration of food delivery in the overall the food service industry was just at about 9 or 10% odd, 3 4 years back, 4 or 5 years back. And this is just the aggregator service share I'm saying, because we all were used to those restaurants delivering at your home directly. I'm excluding that part, of course. So the penetration of the aggregator service of the food delivery was 8 9%, and that is already inched up to almost 15% in 2024. And the estimates, the market estimates, when we look at the industry analysis estimates, they are talking about this going to somewhere between 20 to even 30%, depending on. So BPC is expected to go to 30% and food delivery towards 20%. So I would disagree that it's only the venture capital or the private equities who actually end up gaining the large part of it. The model that they look at investments versus what we look at investments are very different. They are more risk averse, and they are willing to take that bigger risk. The business can completely collapse in that interim first 4 5 years. Whereas, the mutual fund investments, we don't want to invest into such higher, riskier space where the business is just starting off. And that's why they are not even coming to the markets, right? These businesses don't come to the market to raise money from equity shareholders in the first 3 4 years. Usually you would not find it, because the risk attached to that business is pretty high. But once it kind of matures to a certain extent, has a market share, has some credible numbers to show, it's only then when you see these companies hitting the markets for IPOs. And even then, I'm saying that we don't look at every company positively. We evaluate it for sure, but there have been companies that we have not invested, and there are companies that we have invested. So then it totally depends on how we believe that things will evolve, and we've seen these stocks have delivered return. It's not that they haven't. The platform companies that I'm talking about.
So there have been clearly two kind of companies. One have been the platforms, as you said, and then second we have had respective brands which have got listed. Now, the emergence of pandemic saw a lot of D2C brands, digitally native companies that came into emergence, and some of them even got listed. I'm just taking an assumption that it is to probably, get that right share of profitability. These companies have also explored into a lot of uncharted territories and tried to copy the playbook of a lot of other unlisted players which have already existed in this space. For example, on the BPC platform that you referred to has ventured into apparel, and they went from a total online channel to an offline channel. We have another brand which went very aggressive as far as offline stores were concerned. Now, my question to you is that when these companies are trying to replicate the playbook of a lot of other companies, how do you kind of see this decision from an investment standpoint? And it's because sometimes it does raise a lot of concerns and questions about how sustainable it is. So, trying to understand this from that point of view.
Oh, sure, Mega. No, so I think that look, for me to look at any of the platform companies and industry wide. And if I look at China and the US as an anchor market, because that's where we've seen the platformization happen much earlier than it started in India. Both on food delivery and auto was also a big platformization stories there in the outside world, which is yet to pick up in India. So I think that those markets provide a good anchor to for us to understand this area, whether it be D2C or any of the platforms. So one thing has really come out strongly across both these, markets, India and China, is that, US and China, is that there is initially a lot of players who want to get into that space because of the fast growth that segment is showing, because it's just starting off, and obviously there is a there's no boundary to how big it can become. So certainly it attracts a lot of players. And if the funding scenario in the global world is good, then obviously you get a lot of money also to spend and grow big. Initially, you see that, and that spans around 5 to 7 years, that phase where a lot of new entrants are trying to get in. But then eventually, by the time you're in the 7th or the 10th year of that scale up, industry wide scale up, you see that a lot of consolidation starts happening. And then you have realized that only 2 or 3 players eventually end up surviving in the end, and they take a bunch of the market share. In fact, the entire market share is between 2 or 3 players in most cases, if you look at China or the US market. So that template has worked in India as well. If you look at the food delivery, we've had so many food delivery apps. Eventually, we've realized that it's only 2 or 3 which have now survived back. So similar thing is happening in the D2C also. So I think that at least I can tell you that as a fund manager, I get more comfortable when I'm seeing the consolidation behind me, because because until then you don't know who will come out strongly and who will survive, because there's so much happening around you in that market at that point in time. So much funding is happening that cash burns are high, and you don't want to get into that area, at least that till the time the clarity emerges as to who is emerging as winner. And even if you are able to identify winners post the consolidation, there is still a good headroom for growth. Like I said, the food delivery penetration was just 9% 4 or 5 years back, and it's already at 15%. And we are seeing that it has enough room of growth, enough legs of growth going ahead as well. So that's how I look at it. Coming to your specific D2C brands, look, that's also something that we've seen in the US and in China market. There have been some celebrity launched, brand D2C brands, which suddenly become the talk of the town, and then quite a few of them just collapse. They don't even exist a couple of years later. So I think that trend is very natural to happen in India as well, and you will keep seeing that. Parallelly, you're also seeing the HULs and the all the large FMCG brands coming out with something similar, some similar strategy where they are going omni, they are trying to launch products, etc. So I think you will have both sides of the world, the D2C direct, the newer ones, and the stalwarts of the BPC brand, both trying to take some share of this, and we see how it evolves. But as I said, that initially first few years you keep seeing that a lot of brands will try to chase the market because of the fast growth, and it will keep happening at least for the next few years to come as well. So we will be at least very, very careful as to what we want to choose and how we want to play this area until we see some stability in terms of number of players reflecting in the industry.
So, to understand one more dimension, which is often ignored, or rather, which is the strength for these businesses, is that most of the promoters are quite young for these businesses. So, against an average age in a traditional business, which could be relatively on the higher side, here you have entrepreneurs into mid 20s, mid 30s, creating a lot of wealth creation for themselves and for the investors. So, I just want to understand what is the typical difference that you see in the management practices which traditional businesses would have versus the new age businesses?
So I think that the main difference is that they are thinking very differently. I mean, nobody thought the way these businesses have grown, nobody thought that this can be a such a large business. Maybe 10 years back, if somebody would have told us that quick commerce can become, a multi-billion dollar business, we wouldn't have probably believed it. But I think that it's just that out of box thinking that this younger lot of CEOs and the founders are getting onto. And obviously, it does come with risk. No business can, have no risk at all. So these comes, and plus because of the cash burn portion here is so high, that certainly the risk factor is very high until they reach a certain scale, which is where that we see where I and Megha were discussing. That phase is the most critical and the most riskier phase. But then they are thinking out of the box and they are willing to, take that chance and see if the business is becoming, successful over a period of time. But naturally, when it comes to equity markets for raising the money, they've already gained that scale, and there is some bit of certainty in terms of at least, in terms of how they are doing the business. And they would have had their own learnings in terms of trial errors, trying to, change the strategies multiple times, and they would have already learned a lot during their journey of those first whatever 5-7 years. So that by the time they reach to a level of getting listed, there is a certain level of understanding of the business and a good sense of, managing the investor expectation and the minority interest as well. So I think that they definitely come in their journey way up in terms of understanding both the investor community and the business aspects with their learnings that they would have done. One interesting thing which I would like to point out is that the younger lot of these CEOs and the founders have really made this case so interesting for the platform companies, because if you look at traditional companies, the general cycle is that they would do capex and then there will be an asset turnover, and then you will make whatever 2x or a 3x revenue on the capex that you've done, and then again you'll go back to the drawing board and again plan a capex for the next whatever after you attain that growth. You will plan ahead. Versus that, if you look at these companies, the initial years of cash burn that you do, and once you attain the customer size who are sticking to your platform, to your apps very regularly, that's when the cash burn starts depleting and then the profitability curve starts emerging. And the beauty here is that you don't have to do capex every year like any other setup, traditional company setup. So if you are very focused on profitability curve and you're not, and your vision is very clear that this is where you want to be, then the ROE, ROCs for these companies can look tremendously high over a period of time. Because as I said, that they will not need to employ same amount of people every for every growth that they are doing. The main riders and all can go up, but then the main stack of the company, the base of the company, that remains very intact. They don't have to do capex every year. So a lot of those costs which are associated with traditional companies or the capex requirements which are associated there, that certainly goes away. And platform companies don't have to do that. So certainly the business has to grow. You have to keep adding customers. First of all, you have to keep your existing customer base intact, and then you have to add gradually over it. But once you reach a scale, the certainty of you remaining relevant in that particular industry becomes more and more comfortable. So then your profitability can look very high, and as I said, the return ratios can look very, very interesting.
Understood. So, since you're mentioning about capex requirement and investment, so my next question is about that. So, there are two kinds of businesses. So, one which have very high entry barrier, say like food delivery, quick commerce, where you need to put in dark stores every now and then, a lot of investment is required. And then you have second set of businesses which are more marketing and white labeling businesses, like electronics to some extent, FMCG, skincare, and all those things. Now, intuitively, we would feel that the first category should get a higher valuation and a premium valuation. But in reality, when we see, even the second category end up getting quite a significant premium in terms of valuation. So why would that be?
Because of the growth, right? Look at the growth rates of the first category of the companies and look at the growth rates of the second category of the companies. There's at least a 10x difference in the kind of growth that they're doing. So always a fast growing company will attract a higher valuation in that interim period. And then obviously, once the growth rate starts subsiding, then you will see more of normalization happen in terms of valuation versus the traditional or the regular companies. But in the fast growth, and that applies not only to the platform companies, but also to the traditional companies. Look at some of the EMS companies in the industry. Now they are traditional companies, they will have to do capex, but they've still traded at a much higher valuation because of the kind of growth that they're delivering. So it's actually not to do with segmentation of platform versus traditional. It's about how fast growing your company or the sector is. And that particular company or a sector will always attract a higher valuation for that interim period till the time that fast growth sustains.
Got it. And Meeta, another question. So since you were mentioning about valuation and you were mentioning about, how your thought process has to be changed when you're valuing these companies. So my next question is about that. Let's say if you are tracking a traditional business, you are an analyst or a fund manager there, you have your templates. You know how to extrapolate, the earnings for next few quarters. Basis that you can do your DCF, you can arrive at a valuation. But here the companies are new. Sometimes the businesses are new. Sometimes the creation of a new category is happening altogether. As an analyst, as a fund manager, you would have a lot of challenge because there are no fixed templates. So how tough is it to value these companies, and how do you do the valuations here, which is different from the traditional valuation that you end up doing?
So DCF does apply here as well. It's just that while doing the DCF of a traditional company, I would already have some sense as to how the numbers might move. Whereas for these companies, I will have to go down more in terms of do more, on ground checks and do more industry led expert meetings to understand how this industry might behave and how the numbers might eventually evolve. But the templates don't change much because ultimately these are also the businesses. They will also generate cash flows. They will also generate margins and return ratios. So that template doesn't change. But yes, the way I would have thought about a traditional manufacturing led, any industry versus this, obviously that's where the major changes are.
And my one more question, sorry, I'm just trying to understand a little better on this. Again, about valuation. So we know that most of these companies have technology as a very, very critical component, and technology is evolving. So you have terms like blockchain, AI, LLM, and a lot of companies are doing good work in that space. But we have also seen some companies using AI as a very small part of their business, but using it in their pitch to maybe increase the valuation or to convince the investors. So, as fund managers, how do you segregate these two things where you know that okay, this business is actually about AI, LLM, and the other business is not about it, but maybe they are using it just for small measures?
No, so I mean, companies do connect to investors, including us, and try to make us understand their business. But we also have a team which are sectoral experts, which is spent over a decade each in individual that particular vertical or industry, and we also have our own channel checks, etc. So obviously we do our own work. That's what we do day in day out to understand as to how deeply the business is technology driven and how much value it's adding to the day-to-day business.
Understood. So due diligence is a key word here.
Yeah,
So Meeta, with this, we come to the end of the podcast, and one last question, which would be very relevant for our investors is to understand. So when somebody is investing into traditional business or a mutual fund which is playing on traditional companies, there is a mindset about return expectation, volatility, and everything. So when somebody is investing into your fund, which is innovation, digital, what should be the mental framework of an investor who is going to participate in either through direct stocks or through mutual fund route?
so I would say that one, obviously, whether you do direct stocks or a mutual fund depends on your personal risk profile, and your financial advisor may be the right person to advise you there. But given how I manage funds, I can tell you, be it innovation or digital, or I manage focused equity and a couple of other funds as well. So I am very clear as to how I go about managing funds. One is that I want to. I'm a very bottom up kind of fund manager. I don't take top down calls, and if I'm getting very convinced about a certain idea, certain stock based on numbers and whatever management meetings and the channel checks that we've done, then I am willing to give that company a higher weightage in the fund and let it play over the next 2 3 years. I would always want to have at least 50% of my portfolio into such ideas, provided I am able to identify those ideas, of course. But I would want to have at least 50% exposure into these kind of ideas. And the remaining 50%, I generally want to keep it into stocks which may not have a re-rating potential, but they are very stable in their respective industries. They've seen multiple cycles and they've come out strongly most of the times. And they are basically just compounding every year with the growth that they're delivering. Now that 50% odd, I call them as my compounders, and the remaining 50% I call them as alpha. So that's what my approach is. I try to balance between the compounder and the alpha bucket. Now your question was to innovation and the digital fund, and probably we were trying to see that, is this more riskier or less riskier, etc. But this is the approach I take across all the funds. I would say that investors who are looking to benefit from the technology changes that we are seeing all around us, the platformization that we are seeing all around us, then definitely digital fund makes a lot of sense. Innovation is even a few legs higher there. So obviously it encompasses all these IT related or tech related changes, platformization, and also the innovation that is happening across various other industries. Digital fund restricts me to go beyond the tech and the platform sector because it's a sectoral fund. Innovation in that sense is a much wider landscape and allows me to play innovation across multiple industries. So that's the basic difference here. But as I said, as a fund manager, that's my approach, and I try to balance the risk and the reward both when I'm constructing the portfolio.
Got it, Mita. That was really well explained. And with this, we come to the end of our conversation. And it was really a good conversation because this is a segment which all of us are excited about, but most of us are confused about also on how to participate and what should one look at. But a few learnings from this, one which was very important was that there can be different models which PE firm follow versus a mutual fund would follow for these companies. But money making opportunity is available for both. It's not that the money making opportunity for public equity is much lower than that of private equity. Both have equal opportunity. Second, as a fund manager, it's better to analyze and get a direction when consolidation has taken place. It's a very important learning because many a time we get carried away by the noise around us and we miss, important opportunity. And one interesting aspect was, which you mentioned, was that once these platform companies reach a certain customer size or segment size, then the profitability curve is really, really strong because unlike traditional businesses, there are no capex requirement every now and then. And lastly, to carry home the point, it's important to have a mix of alpha and compounders in the portfolio if one is looking a diversified approach in this segment. And I think that's very, very important for retail investors because that A reduces the risk to some extent and B ensures that there is some predictability of return. With this, we end our conversation. Thank you so much, Meeta, for taking out time on a busy day. I really appreciate.
Thank you. Thanks, Harsh. Thanks, Megha.